Henry, I know you've been watching coverage of the DOJ's antitrust suit against Google. I certainly have. Is it possible that a broad antitrust crackdown against big tech, not just Google, but potentially Facebook, Amazon, etc., could constitute a macro risk?
Yeah, I think that's a fair assessment. I mean, generally, what you see is when sectors become really important in the overall market. You saw this around 2000 with financials. You start to see more regulatory scrutiny. And so the same way that there was a push to re-regulate the banks after 2000 and 2007, you're seeing that now with tech. It's been the leadership sector. That's where the innovation is, and certainly it's forced the regulators to take an eye and look and see about monopoly pricing power. And so I don't think this is a blip. I think we'll have more issues or more press around this type of control issues for the different large players across tech and other parts of the economy.
So antitrust, big tech antitrust is a potential risk. Election risk is a real risk. It's here and now. The election is in less than 2 weeks. Henry, is election risk fully priced into the market?
I think the market has actually been pricing in that essentially a Biden victory. When you look at those type of stocks, they've been performing better. You see that if you look at stocks with low tax rates and high tax rates, they're acting like there's going to be a wave of blue. Ultimately, I think what the market doesn't want to see is a really unsettled view where essentially there's a contested election. So, when you look at the volatility curve, that's what it's pricing in. I think in recent days, just some of the things you were highlighting around tech, you've also started to see some of the small cap stocks, more cyclical stocks start to perform. I think one of the things that we should take some encouragement in just in the United States is inventories are low. You've seen consumer spending remain fairly robust regardless of the problems that we've had around more stimulus coming, and ultimately the savings rate is high. And so I think the consumer is in decent shape. I think the market is discounting in that this recovery will continue, and that's our base view at KKR.
The election is a near-term focus for investors. An even nearer-term focus is the potential for a new round of fiscal stimulus if Nancy Pelosi and Steven Mnuchin can reach an agreement. At this point, Henry, through your macro lens, how much can more government spending fix what ails the economy? Because at least as I see it, government spending can't pack casinos and fill cruise ships.
Right. It's a good question. Look, I think we've used stimulus, both monetary and fiscal, as a blunt instrument. I mean, when you look at the U.S., it's 40% of the total global stimulus of $25 trillion. Remember, in 2008, China really was the lead horse when it came to stimulus. This time it's been the United States. So I think what we need from here is a more targeted approach. When you look at where the unemployment, unfortunately, has occurred, it's occurred really in three sectors. One is travel and leisure. The second is education and healthcare. And the third has been services. And so, if you could wave a wand, that's where you would have Washington focus. Ultimately, we're seeing a little bit of disturbing trends in the unemployment rate. When you look at those unemployed 27 weeks or longer, that's really spiked up. It's about 20% of total numbers of people in America that are unemployed. And so that's where we're going to need more job retraining. We're ultimately going to need more handholding and stimulus to help those individuals make it through.
Clearly, unemployment, long-term unemployment is a priority for the Fed, and Fed action has helped tremendously to restore financial conditions in the U.S. economy. Henry, one of the many charts that you offer in your latest report, The Road Ahead, is actually the Bloomberg U.S. Financial Conditions Index, and I'm going to bring it up so that everybody can see what a remarkable recovery it has staged. What is this chart telling us?
Well, it's telling you that the Fed has been incredibly effective. They came early, they came in size, and they created confidence. And that was really important for helping American companies get back on their feet and ultimately sustaining employment. I think from here, though, and this is why I think you saw some dissension in the Fed during their last meeting, ultimately, the Fed needs to create both the carrot and the stick. And so the carrot is that they're going to keep rates low and they're going to keep financial conditions easy. I think the stick is that they don't want to create financial instability. And that was referenced by the Fed and Chairman Powell. I think that's important. And what he said is he could tweak the rate of QE. They could do more regulation of the banks. You've seen that the Fed right now doesn't want the banks doing big payouts or buybacks heading into year end because they want to make sure they have plenty of equity cushion. So, if we were in a 10 out of 10 risk environment, we're probably in a risk-taking environment. We're probably in a 7 to 8 environment. So I think the Fed has the markets back, but they want to make sure that we don't do any long-term damage by having too much money funnel into the financial markets and not find its way into the economy. That's a very important. Each cycle is different. What's really been I'd say, somewhat alarming but also illuminating is the bifurcations we've seen in this market, where you've seen, 5 stocks do really well. It kind of gets to your point about why there's greater scrutiny of the tech sector, and then contrast that with areas that have, had a much tougher time around, energy or something like that. So I think what we need to all root for is this stimulus, both monetary and fiscal, get them to plug the holes where we've had more problems. I think the IG market, the investment grade market, is doing just fine. I'm not sure we need a lot of support for big companies that can issue. Insurance companies need yield, pensions need yield. It's really the ones where the companies that are having a harder time accessing the market, and that's why there's been such focus on the Main Street lending program. Ultimately, a firm like KKR, we do a lot of lending to small to medium-sized businesses to help them get back on their feet. And I think there's more firepower that the government could put behind that part of the equation.
Henry, you raised your fair value estimate for the S&P 500, by almost 10% to a range of 3350 to 3450, if I'm not mistaken. That's pretty much where the market is right now. What would it take you to raise that again?
I think ultimately, what you'd want to see is just we're arguing for a square root recovery. Kind of comes up very sharply, and then it moderates as you have more, I'd say, cases pick back up in the fall and the winter, and that feels like what we're seeing. Ultimately, if we had another bazooka of stimulus, which could happen under the Biden administration. The other thing that I think people aren't talking about is companies are really keeping their costs in check, and that's driving profitability. So margins, are actually going up at a pretty rapid clip. So there's a variety of factors. I think we've done a decent job. There's obviously been a fog of war, and we've tried to provide investors, with a roadmap. Generally, when you have a 25% correction, you typically just want to get long stocks that thereafter for the 3 years. So we don't, KKR, most of our capital is kind of 5 to 10 years. So when we focus on the long term, I think one of the things that we've really tried to be focused on this year is getting our themes right, and we're not moving our capital around periodically like some of the things that Bloomberg does report on. So that's really the area of focus at the firm, which is where can we find GDP plus growers, companies and sectors, and make sure we understand that on a global basis. Well, I think the lens, particularly given our footprint in Asia, has been incredibly helpful, because that's the part of the economy globally that has rebounded much quicker. And there are definitely signals that we've been able to embrace from Asia and to use that effectively to deploy capital in both Europe and the U.S.
I want to pick up on that quickly. In your report, you say, and I'm quoting directly, the secular bull market in the U.S. dollar and its interest rate advantage may now have finally run its course. That's a sea change for investors. Does that mean, Henry, that the trillions of dollars of global capital that flowed into U.S. assets seeking yield in return in the decade that followed the financial crisis is now going to flow out?
I don't think it's going to flow out in a rapid clip. But what I do think is happening is, given the Fed stimulus, what you've seen is that real rates in the U.S. have dropped to such a level they're now on par with Europe. That was never the case before. So, rates are negative in Europe and the U.S. about 100 basis points. That's a pretty interesting data point. Typically, that would mean that the dollar would go down. And if we're right about that, there are definitely some action items, which is you would own more exporters in the U.S. You would be more focused on emerging markets in Asia, which we certainly are. And then you really would go do more around asset-based collateral, things like housing, where we're very active, things like infrastructure, where we're very active, things like real estate, both the equity and the debt side, where we're active. So there's a call to arms. I think You see this not in the way we deploy our funds, and also how the firm has used its balance
Henry?
sheet to
We
invest.
will
alongside
leave
us.
it with the call to arms